Today, we are going to look at how to determine the fair value of any stock within minutes. When I say within minutes, I mean within minutes, a short time. You have some money, you want to invest in the market, and you want to know the fair value of the stock you're interested in. So you can quickly do that to determine whether you should go ahead to invest or you should wait. The techniques that we will be using is called the PE ratio. It's a commonly used technique and is widely used by most investment professionals. It helps us to determine whether a stock is cheap or whether the stock is expensive. Whether a stock is undervalued, whether it's fairly valued, or whether it's overvalued. It's a technique that we use in stock valuation. There are several other techniques, but it's one of the most used technique in valuing stocks. The formula is the price per share over earnings per share. The price per share is something you can quickly get from the stock exchange. What is the price that the stock is selling for as at the time you are doing this valuation or you are calculating the value of the share? It's not the price that the stock was selling for last month or last 2 months, but we are saying what is the current price of the stock as at the day you are carrying out the valuation. Another part of the formula is the earnings per share. Quarterly, each company used to bring their report to the markets. They used to submit their report to the markets. And in that report, you'll find a part that talks about the diluted earnings per share. That is the part we are using, the diluted earnings per share. So this is the formula that is presented before you, price per share over earnings per share. We'll take an example. Let's say company A is currently selling for 50 naira and the EPS is 5 naira. When you divide the price by the EPS, you get the PE. The PE is usually in multiples. So when you divide, in this example, if you divide 50 by 5, you get 10. You see there now, the PE is written 10 times. So PE is usually in multiples. So what that would mean is that this company, if you are buying it today at 50 naira, if the earnings remain as 5 naira per share, it will take 10 years for you to break even. That is what it means. If they continue to release an earning of 5 naira every other year into the foreseeable future, it will take 10 years for you to break even. So that is what PE means. There are different types of PE ratio. There is a trailing PE ratio, there is forward PE ratio, and there is normalized PE ratio. But in each of these ratio or PE ratio, price is always constant. Price is the numerator, while earnings is the denominator. In each case, the P that stands for price is always constant, is the current price that you are taking. In this case, what is the current price now? What is the current price now is what you are taking, whether it's in trailing, whether it's in forward, whether it's in normalized. The difference is the E, the earnings. In the case of trailing, the E is the earnings per share for the last 12 months. When you calculate the earnings per share for the last 12 months, you get the E. In the case of forward, the E is forward looking. We are not calculating the past, we are now forecasting the future. That's what we are doing. So when you get the expected future earnings for the next 12 months, that is the earnings you use in the case of forwards. And then in the case of normalized, the future earnings that you have calculated, you adjust it for cyclical uh, economic events or one-time events, or maybe inflation. And that is how you get the E that you use for the normalized PE ratio. Using PE to determine fair value. Don't forget, what we are trying to determine is the fair value of the price. Now, how do you use PE to determine this fair value? There's a formula. The formula is estimated PE multiplied by the fair PE. Estimated EPS, I take that again. Estimated EPS multiplied by the fair PE. Estimated EPS, like I said in the previous slide, is the forecast EPS for the next 1 year. What is the forecasted EPS for the next 1 year? And you can do this forecast by doing a little bit of research in the company activity. Then you can forecast what the EPS is likely going to be. It may not be exact, but you should be close to it. Then how do you determine another part of the formula for using this PE to determine fair value is the fair PE. How do you determine the fair PE? You can determine it from the history, the PE history of the company. You know that each time the company release an earnings report, a PE is always determined. And you have some of these um, trading machines or like trading view, charting machines. Some of them have record of the PE for companies like trading view. You can find the historical PE for each company that you are referencing. So from there, you can look at a sizable period of time, say 2 years, take the average historical PE, That will give you the fair PE. Another way you can determine the PE is to do the industrial average. Say, for example, you are using the banking industry. You take the PE of each bank in the banking industry and add it together, divide by the numbers of banks, then you get the industrial average. So that industrial average will now also be a fair PE. When you multiply that fair PE by the estimated EPS, you get the fair value. Let's now look at the step-by-step calculation of fair value. You estimate EPS, estimate earnings for the next 12 months. That is step one. Assign fair PE. Like we said, either you are using the historical PE of the company or you are using the industrial average. So you can determine the fair PE. Then multiply the estimated EPS by the fair PE, then you get the fair value. You compare this with the current price, the fair value you have calculated. Let's assume you calculate the company to be 50 naira or $50 as the case may be, fair value. And the company is currently selling at 40 naira or $40. You agree that that company is undervalued. So the difference between the price you calculated, the fair value price you calculated, and the current price will now determine whether you would invest or you will not. If the price you calculated is close to the price the stock is selling, you may not have much motivation to invest. So we usually would prefer when a stock is grossly undervalued, like buying $1 for 50 cents, that you have a very wide margin of safety. And that is usually the best time to invest. How to choose the fair PE? Like I said, you can use the historical company PE or use the industrial or market average. The industry or market average. Then you adjust this PE for growth and risk and other economic events. Then you get the fair PE. We now take the limitation of the PE ratio. It looks very, very, very quick, short, and straight to the point. Like we still have some limitations. Like one, when a stock is reporting negative earnings, like it's making losses, PE does not work for such a stock. You can't calculate the PE when the earnings is negative. Then when there are one-time events, it also distorts the PE. One-time event like a very big segment of the company was sold. And so they make a lot of gain from selling that segment. and that's a lot of gain. When you bring it into your income statement, it will mean that it will increase the profit for that period. It will increase it very well. So what we used to do is I will remove that profit from discontinued operation. We'll remove it from the income statement so that we can know what exactly is the earnings, the regular or sustainable earning of the company. Then another limitation is that you may have some companies that have high PE. You've been wondering. Companies are normally, the average company are having 10, a multiple of 10, multiple of 15. You see a company having hundreds. It becomes difficult to use that kind of, to calculate, to use that kind of PE to determine the fair price of the stock. There are some stock that are also cyclical in nature. All this can also mislead in trying to determine the fair price using a PE ratio. So these are the few limitations of the PE. There are more, but um, these are the few we are naming here. Now, if you are a Nigerian investor and you're investing in the Nigeria Stock Exchange, there are some practical tips that you may want to take away. It is good that you compare local pairs. When you have determined your PE or your fair PE, compare it with other companies. Let's assume that you are trying to value UBA or you are trying to value Stanbic IBTC. Why not compare the PE ratio of Stanbic with companies like GTCO or companies like Zenith? So that will give you an insight to determine whether your fair PE is okay, is good to go, or you might need to do some adjustments. Then it's also necessary to adjust for inflation and risk. You understand that inflation has been going in double digits recently, at least for like 2 years in a row. Inflation has been going in a double digit, so we need to make adjustments for inflation. You agree with me? A naira today is not a naira tomorrow because of inflation. So we need to make some adjustments for inflation and risk. And when we are using historical um, PE to determine fair PE, it is also good that we use multi-year average, not just 1 year average. That's 4 quarters average. No, if you take it across board, say like 3 years, 2 years, and you get the average of that length of a period, you are most likely going to get a fairer PE to use. Then it's also good that when you have determined the fair value using the PE ratio, that you compare that fair value with other ratios. We have ratios like price using the price to book ratio. We have ratios like using price to sale, price to cash flow, then the DCF model. These are other model you can also use to determine the fair value of a stock. So, but this course lesson is how to use the PE, the ratio, to determine the fair value of a stock. So once you have determined the fair value using the PE ratio, compare that value with other value from other model, like the price to book, like I have said, price to save, price to cash flow, uh, discounted cash flow model. So let's remember these tips. They are very good. Then in summary, PE is a simple but powerful tool. Estimated PE and assigned fair PE. I've discussed how we can get estimated PE. It's forward looking. You calculate your PE for the next 12 months, then you adjust for risk, for inflation, and other one-time events. I've also discussed how we can calculate the fair PE. The fair PE, you can calculate it from either you are using the historical average, you are using the industrial average, or you are using the market average. Compare fair value with market price. I've also mentioned that. Use with other analysis methods. I've also discussed other model that we can use to value stock. Once you have determined your fair price or your fair value, compare with other model and know whether you are good to go. So questions and discussions. Have you used the PE ratio before? You can leave that your answer in the comment section. So if you have used the PE ratio before, what challenge have you faced in stock valuation? So you please leave those answers in the comment section. So that will be the end of the course or the lesson. How to determine the fair value of any stock within minutes. You agree with me that using the PE ratio, as has been discussed, is a quick approach to determining the fair value of a stock. So I will see you in the next class when I will be taking us on a different topic. Thank you for listening.